Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And today's question comes from Dan of Toronto, Canada. Alan, I've only used out-of-the-money strikes when selling covered call options, but I see you use in-the-money strike prices as well. How do you determine which is the best strike price to use? Well, Dan, there are several factors involved in strike price selection. You're correct that the out-of-the-money strike price is the one that most covered call writers use. And the out-of-the-money strike as well as the at-the-money strike are both bullish positions as it relates to covered call writing. We use those when we have a positive market outlook, when the chart technicals are positive and confirming, and when the investor himself has a higher risk tolerance. Now, the in-the-money strike price is the one that we use when we have more of a bearish or a volatile market outlook. That is more of a conservative approach to covered call writing. And we use that when the chart technicals are mixed, and again, the market outlook is more bearish or volatile. So as an example, let's take a look at an example I've taken from my last book, The Encyclopedia for Covered Call Writing. And as you see on the screen now, we're going to take a look at the options chain for HITK. And in the upper left-hand corner, you see the current price at the time this chart was made was $22.34. So if you look down to the bottom of the chart, we'll then take a look at three strike prices. The in-the-money $20 strike, which generates a return of $3.10 for the 1 month option. The $22.50 near the money strike price, very close to at the money, which generates a return of $1.70 for the 1 month. And the out of the money 25 strike, which generates a return of 80 cents or $80 per contract. Next, we feed this information into the single or multiple tab of the Ellman calculator, and on the screen you can see the results. Now, if you take a look at the third row from the bottom of circled returns, you see that the in-the-money $20 strike returns 3.8% for the 1 month. The $22.50 near the money strike returns 7.6% for the month. And that's typical of at-the-money strikes. They always give you the highest initial return. And to the right, you see the 3.6% 1 month return of the out-of-the-money $25 strike. Now, let's take a look at the middle of the page where you see the downside protection. Only the in-the-money $20 strike offers the downside protection, which is protection of the initial options profit. And you can see that the 20 strike offers a 10.5% protection. What that means is the 3.8% initial return is guaranteed as long as the price of the stock does not drop by more than 10.5% in that 1 month. Now, if you take a look at the column to the right, the out of the money $25 strike, you'll notice that there is an additional possibility of 11.9% additional profit if the price of the stock moves up to the $25 strike. So the potential 1 month return for the out of the money strike is 15.5%. So to summarize, Dan, we'll use the in the money strike as a more conservative approach when market conditions are volatile or bearish and chart technicals are mixed. We favor the at the money and out of the money strikes when the market conditions are bullish, chart technicals are all positive, and the investor has a higher risk tolerance. So Dan, I want to thank you for that great question. I know many of our viewers will benefit from it. This is Alan Ellman, the Blue Collar Investor. Take care, everybody.